Welcome back to my YouTube channel. And if you are watching this channel for the first time, please take a minute or two to subscribe to this channel. Yeah, this is a channel where we'll be able to pass your BDA on first attempt. And without further ado, let me read the question now. And this was a mock for April 2024 sitting, sorry. So I'll read the question. It was question 22. So I'll read it here. As a senior financial analyst at OML Capital, you have been tasked by the chief investment manager to develop a financial model for a new startup company that plans to manufacture and sell electric bikes components in the country. The following information is provided. 1. The company is expected to produce 1 million units annually. Yeah, so I'll note here the 1 million units. Yeah, then the number 2, the unit selling price is expected to be shillings 18.5 in 2024. Yeah, so the unit selling price will be 18.5. Number 3, the unit selling price is expected to increase by 5% annually over the next 5 years period. Yeah, so it will increase at the rate of 5% over the next 5 years. So number 4, the cost of goods sold in bracket percentage of revenue is 42%. Yeah, so it will be 42%. The salaries and benefits expense in bracket percentage of revenue is 17%. So I will also note that 17%. Yeah, sorry. Let me just change this into 42%. Yeah, the number 6, the annual rent and overhead expense are shillings 500,000. So I just note it here, 500,000. That's okay. Number 7, depreciation and amortization percentage of property, plant, and equipment is 25%. Then interest rate percentage of debt is 10%. So I'll also note that. Then the applicable tax rate is 30%. So I'll also note that. Then account receivable days is 30. So I'll just write here 30. The inventory days is 14. So I'll also write 14. The accounts payable days is 30. So I'll also write here 30. The number 13, capital expenditures in year 0 is shillings 15 million. So let me write here 15 million. It will be funded by debt issuance of shillings 5 million. Yeah, so there was a debt of 5 million. Then we had an equity of 10 million. Yeah. So what the examiner is trying to say here is that the capital expenditure, which in this case, capital expenditure is what we use to, is the expenditure that is used on fixed asset. Actually, it's considered as a non-current asset. So it means that the capital expenditure balances equity and liabilities at 15 million, 15 million. Yeah, that's why they're saying it will be funded. Yeah. So that the statement of financial position is balanced at 15 million at year 0. And year 0 in this case is the 2024. Yeah. 2024, where now we'll start forecasting for the next 5 years. Yeah, so I'll go to the required using Excel. A, prepare the following financial statements: statement of profit or loss for the 5-year period. Yeah. Then number 2, statement of financial position for the 5-year period. Number 3, cash flow statement for the company for the 5-year period. B, undertake ratio analysis and compute the following financial ratios for the 5 years. We have profitability ratios, return on assets ratio, return on equity ratio, and net profit margin ratio. Then we have number 2, liquidity ratios, current ratio, and quick ratio. Yeah, so I'll go through the question. Yeah, so I'll start with the Roman 1, statement of profit or loss for the next 5 years. So this is what I will do. Write forecast statement of profit or loss. Yeah, and it was a 5-year. Yeah, so I'll start from 2025. Yeah, so I'll have 2025, and the 5 years will end in 2029. So I'll have 2025, 2026, 27, 28, 29. Yeah, so I'll just go to series the way I've taught you. You just come to fill, then you go to series. Then on a row, then my stop value will be 2029. Then I'll say okay. Yeah. So I'll just bold this. So once I've bolded that, I'll create the bottom border. Yeah, the bottom border there. So this is a statement of profit and loss. So I'm supposed to start with the revenue. Yeah, but I don't have the revenue directly. So I'll start with the units. Yeah, so we are told an additional information number 1 that the company is expected to produce 1 million units annually. So it's constant all through. There was no growth rate on units. So it was constant. So I just pick it. Then I'll also copy it. Then I cannot now drag to fill the remaining years. Then the next item is the selling price. Yeah, because the revenue is always selling price times units sold. So I just say SP. Yeah, that's my selling price. Yeah, so the selling price will be, we are told that an additional information number 2, that the unit selling price is expected to be shillings 8.50 in 2024. And number 3, the unit selling price is expected to increase by 5% annually over the next 5 years. So it was 18.5 in 2024, which is in this case is the year 0. Yeah, so it will increase by a growth rate of 5%. So I'll say 1 plus 5%. Now, when you get to year 2025, yeah, because it's increased annually. Yeah, so it means that if it was 18.5, then it has increased by 5%. And what I will do to the 5% is that I'll just lock it completely. Yeah, lock it completely with an F4, then I enter. So when I enter, let me see if I drag, it will copy. No, it won't copy. So I'll go to the next second year. So I'll pick this. Yeah, and it will also have a growth rate of 5%. So I'll just write F4, then I enter. Yeah, so from here, I can comfortably drag and I'll have the selling price all through. Yeah, you can see. So the next thing here is the now revenue. So the revenue will be equals to the selling price times the units. Yeah, I have my revenue there. So when you drag, it will multiply automatically. Yeah, so the next thing after revenue is always the cost of goods sold. So the cost of goods sold, I just put cost of goods sold. Yeah, I'm just putting that way, COGS. Yeah, so the cost of goods sold, we are told an additional information number 4 that the cost of goods sold percentage of revenue is 42%. So what does this mean? So it means that the cost of goods sold will be 42% of revenue. So I just take this 42% and I'll lock it completely. Then I'll multiply by the revenue for the first year here, which is 2025. Then because I want this cost of goods sold to be negative, I'll put a negative sign before revenue. So I just enter. So once I enter, because I already have locked the 42%, I'll just drag, and you can see the values change automatically. Yeah, so the next thing will be the gross profit. Yeah, the gross profit. Yeah, so the gross profit will be equals to the revenue minus cost of goods sold. So I'll just sum this because already cost of goods sold is on negative. So I'll sum these two. Then I enter. Then once I enter, I'll just drag. Yeah, so the next will be the expenses. So I'll start with the first expense, which is the salaries and benefit expense. So I just come here and say salaries. Yeah, so it's an expense. So they're saying it was at 17% of revenue. So I'll pick 17%, then I'll lock it. Yeah, lock it completely. Then I'll multiply by revenue because it was of 17% of revenue. But I want the expense to be negative. So I just put a minus before revenue. So that's when I enter, because already I've locked the percentage, I just drag on through. Yeah, the values will be there. So I'll go to the next item, number 6. The annual rent and overhead expense are shillings 500,000. So I just write rent, rent. Yeah, it's rent and overhead. So let me just write rent. It was 500. So I also want it to be negative. So I just say equals, then I put a negative sign, then I pick 500. Then I will copy it. Yeah, because it was constant all through. Yeah, there was no growth rate. Then I'll go to the next item. We have depreciation and amortization, which we are told is the percentage of property, plant, and equipment. Yeah, so I'll just write depreciation, debt, and amortization. So when I come to this depreciation and amortization, we are told that it's percentage of property, plant, and equipment, but we don't have the property, plant, and equipment in this question. So what always happens is that the capital expenditure, for you to calculate the capital expenditure equals to the net increase in property, plant, and equipment plus the depreciation expenses. So that means that we take the 25%. Yeah, when now you make the depreciation to the subject. So you just take the 25% and you lock it, yeah, for depreciation, and you multiply by the capital expenditure, because capital expenditure is a non-current asset. Yeah, it's a non-current asset. So you just multiply by the amount given as the capital expenditure, which in this case is 15 million. Yeah, so I've already locked it, but I want it to be negative because it's an expense here. I just put a negative sign. So once I do that, I just drag all through. Sorry, I don't know why it's not copying. So I'll have to, let me just copy this, see if I can drag it now. Yeah, so that's the depreciation and amortization from 2025 to 2029. So another expense will be interest. Interest rate, they say percentage of debt is 10%. So I just say interest. So the interest will be the 10%. We are told that the interest was 10%. So I'll take the 10%. I'll just lock it. Yeah, because the rate is constant. Then I multiply by debt. Yeah, because it was 10% of debt. And debt here we are told it was 5 million. So I'll put a negative sign because I want it to be in negative. So that when I drag, I don't know why it's Yeah, so let me just copy it because it's constant. The second cell, then I can just drag it here. That's okay now. So the other thing is now, after that, now we'll have the profit before tax. Yeah, we'll have the profit before tax. So it's profit before tax. So the profit before tax will be equals to the sum all the way from gross profit. Yeah, here. So I'll sum all through up to interest. Then I enter. So once I enter, just drag this all through. Then I'll now have the tax. So my tax will be equals to, the rate we were told was 30%. So I'll just pick 30%. Then I lock it completely. Then I multiply by this. But I'll put a negative sign before the profit before tax item so that I can have my tax on in a negative. Yeah. So that when I drag, it will copy automatically. So the next thing will be profit for the year. Yeah. Or profit after tax. So let me just say profit for the year. So the profit for the year will be the sum of these two. Yeah, then I just drag this over. Yeah, so with that, I'll be done by, yeah, so that's how you are supposed to do part 1 of, yeah, Roman 1, yeah, statement of profit or loss for the 5-year period. So this is what we are supposed to do. And with that, you are done with that question. So I'll go to the Roman 2, statement of financial position for the 5-year period. So I just write statement. Yeah, this was a forecast statement of financial position. So I'll bold it. This comes equals to pickups. Then I drag it. Yeah, that will copy. Then I bold this and create the bottom border. So I'll start with the non-current assets. You know, we always start with the non-current assets. So I just write here non-current. Under the non-current assets, I will take the capital expenditure. Yeah, because that's what falls under the non-current assets. Yeah, just as I said, we were not given the property, plant and equipment directly, but we're given the capital expenditure. So the capital expenditure will form part of the non-current assets, and it's always at the net book value. Yeah, it's always at the net, because it's the increase of PPE plus depreciation expense. So it is always at the net book value. So I'll pick the capital expenditure. So I'll write it. Yeah, so there was no movement, there were no changes. So it was constant all through. It was constant all through. So I'll pick the 150. Then I drag it. Yeah, so that's the net book value. Yeah, that's the net book value. So the next thing will be the current. Yeah, the current assets. Yeah, because when you're done with the non-current, now we come to current. Let me just bold it. The non-current assets will start with what were given on the question. You can see the inventory. We said the inventory days is 14. But you see, now the inventory days, this is the formula for the inventory days. The formula for the inventory days is the inventory over cost of goods sold times the 365, which is now the year. But you see, in this question, it's always the average inventory over cost of goods sold. But the examiner did not provide the average inventory. Yeah, the average inventory, you only calculate it when you have the opening inventory and the closing inventory so that you can get the average. Again, the examiner does not provide the net purchases because it's easier to calculate the closing inventory when you have the net purchases and the inventory at the beginning. So we are not given the inventory at the beginning, the same way we were given the capital expenditure at the beginning. So I found it so difficult because I think this question was not moderated. I find it so difficult to calculate the inventory. But when you come to now the other item, which is the accounts payable, the accounts receivable, which is an current assets, we can calculate it. Yeah. And we know that for the formula for account receivable days is always accounts receivable you divide by revenue times 365 days. So in this case, the examiner was testing your knowledge on whether you can get the account receivables. Yeah, when you are given the accounts receivable days. So I just say accounts receivable. Yeah, I have not included what we call the inventory because I found out that the information given here was not complete for us to get the closing stock. Yeah, so you will also do it on your side and maybe you see maybe you comment below and tell me how you calculate the inventory because we didn't have the opening inventory and even the net purchases. Then with this now, the formula for the inventory days is the average, which means we must have the opening plus the closing, which in this case we don't have both. Yeah, we don't have both. But for accounts receivable, I said the formula was account. Yeah, now you make the formula for accounts receivable days is account receivable over revenue times 365 days. So where you are, you have to make the accounts receivable now the subject of the formula. Yeah, to make it the subject of the formula. So when you make it the subject of formula, then the account receivable will now be revenue times account receivable days we divide by 365. That's something you can do back at home. Huh? You can do it back at home when you have the formula. So I'll just do it. The account receivable now will be the revenue. So I'll just go to revenue and check what was the revenue in 2025. It was this one. Yeah. So I'll have to multiply it by by the account receivable days. Yeah. So what was account receivable days? It was 30. Yeah, it was 30 days. So I'll lock it because this is constant. So let me lock it completely with an F4. Then all of this I'll have to divide by 365 days. So let me just undo this and I write 365 days somewhere. Yeah, 365. Let me write it here. Yeah. So I'll go back to accounts receivable and I'll explain. The account receivable, when you are given account receivable days, then you make the account the formula for account receivable days is account receivable over revenue times 365. Now you make the account receivable the subject there. And when you make the account receivable the subject of the formula, then the account receivable now will be revenue times account receivable days. You divide all that by 365. So that's what I'll do. I say equals to, then I'll put a bracket. Put a bracket there. So I'll pick the account receivable. I'll pick the revenue. Sorry, pick the revenue. So that's the revenue. Then I'll multiply by the account receivable days. Where's the account receivable? So days were 30. So I'll multiply by 30. And you can see this 30 is constant all through the forecast period. So I'll have to divide it by the 365 days. Yeah, what is in the bracket? Then I'll lock this also completely because the 365 days also apply across the forecast period. Yeah, and I told you the locking is all about sparing on time because you can't calculate for 2025 you go to 2026. So that's why I've locked it. Yeah, so I'll have that value so that when I drag, because already I've locked, the values will come automatically. Yeah, you can see. Yeah, the values will be generated automatically. Yeah, so the other item which was supposed to be here was supposed to be cash and cash equivalents. And from this information, there's nowhere where there's cash and cash equivalents. Yeah, it's nowhere. So I think to an extent, the examiner maybe did not provide complete information. You can also comment there. Yeah, the comment section. The examiner maybe did not, the information here was not conclusive. So I will only work with what I have. So I'll work with what I have. So the account receivable is that. So with that, I think this is all I was given. So I just say the total assets. Yeah, the total assets will now be the sum of these two. So I just sum this. So just drag on through. So I just highlight these total assets, bold it. Then I will create the top border. Then adjust the bottom. Oh, sorry for that. Yeah, sorry for that. So we continue. So I'll now go to equity and liabilities. So equity and liabilities. Yeah, so I'm just, I'll bold this also. Now then I'll start with equity. I'll start with equity. So the equity, we were given, we're told that it was equity of 10 million. And you see, there were no adjustment. There were no new issue of new shares anywhere according to this statement. So we'll retain the equity all through. Yeah, so we'll have it all through. Let's come here and add this. Then I'll just drag this. Then the next thing is the non-current assets. That order. So let me just write here. Non-current. Sorry, non-current liabilities. And I'll also bold this. Yeah, so under the non-current liabilities, what will we have? We had a debt. They say that capital expenditure in year 0 is shillings 15 million. It will be funded by debt issuance of 5 million. Yeah, so this debt also, there were no acquisitions. So we assume that it remains constant. So I'll just write here debt because that's what they're giving. So I assume it's a long-term debt. Yeah, assume it's a long-term debt. So I'll pick it. And then it will be constant all through because there was no acquisition. Then I'll go now to the current liabilities. So I'll bold it. And the current liabilities, we have information on accounts payable. So write accounts. So accounts payable would be the same thing. The formula for accounts payable days is accounts payable over revenue times 365. So the accounts payable now will be the subject of the formula. So it will be revenue. So just put a bracket revenue. Yeah, you go back to your ratios and cram those formulas. Yeah, cram those formulas. So I'll go to revenue and I'll multiply by the accounts payable days. The account payable days was 30. Yeah, so I'll lock it. Yeah, because 30 is constant. Then I put a bracket. Then I'll divide by the 365 days, this one. So I'll also lock the 365 days and enter. So once I enter this, I'll just drag. Yeah, so there was no any other information. There was no any other information which was given on under the current liabilities. Yeah, I don't see any other information. I don't see any information. Yeah, so I'll go to total equity and liabilities. So I'll say equity and liabilities. Yeah, just sum this. Yeah, so I'll bold this. Yeah, and I can see it's balancing. Yeah, if the examiner, yeah, it's balancing. I can see it's balancing on both sides. Yeah, it's balancing. So let me create the top border, then a double bottom border. Yeah. So with that, you're done with the part 2. So part 3, we'll have the cash flow statement for the company for the 5-year period. So I'll do the cash flow. Cash flow statement. So I'll bold it. So we continue the cash flow statement. So the same way, we'll just copy the years. Yeah, so we'll start with operating activities. And operating activities, so we'll start with the profit before tax. We'll start with the profit before tax. So I'll just come here and pick this. Then I'll copy the profit before tax from here. Then I'll adjust 4. After this, I'll adjust 4. So we always adjust with, we start with depreciation, amortization, or impairment. Yeah, so we add them back. So I'll add back the depreciation and amortization, this one. Yeah, so I just come here and I'll add. So I'll change them to positive. So I'll put a negative sign before, then I just select the values, then I drag. The values will change to positive. Then the next item after depreciation and amortization is interest. Yeah, the finance cost. So I'll just come here and copy the interest. Yeah, I'll use the statement of profit or loss. So I'll just come here and pick the interest. Just say equals. Also, this will be in positive. So I'll pick this. Yeah, already it's in positive because I put a negative sign before. Then when I copy, the values will be okay. So when I go up to, I can see there's rent. Those are our administration cost. So we don't adjust them for under cash flow. Salaries and benefits, those are also administration costs. Yeah, we say that administration and distribution, we don't adjust. Then we have the gross profit. Yeah. So those are the only adjustments that we are supposed to do under operating activity. So here you can write cash flow from operations. So that would be the sum of all this. So you just enter, then you do. So let me just bold this so that you can see it clearly on your side. Yeah, so this is always my A. So I'll just say bracket and I put A. Yeah, then I'll go now to the investing activities. Investing activities. So the investing activities, now, investing activities, I say, that's one now where the capital expenditure come in. Yeah. So capital expenditure is always classified under investing because it's a cash outflow. Yeah, you are using money to acquire a property. So it's a cash outflow. So I just come here and copy the capital expenditure. Then it's a cash outflow in this case. So I'll put a negative sign before start it. Hmm? Yeah, that's it. So we'll have cash flow now. Cash flow from investments. Cash flow from investment or investing activities. So cash flow from investments now will be this. Up to then. So it's cash flow from investment. So I just bold this. We bold this. So I'll go now to financing activities. And financing activities are said that we look at the debt and equity. And when you look at the debt and equity, nothing much happened. Huh? There were no issue of new shares. There was an acquisition of more loan during the period. They were silent on that. So the only thing that we had, which we paid all through, was the interest. Yeah. So I just come here and say interest. Say equals to, then it has to be negative because it's a cash outflow. So where was the interest? Yeah, it was negative. So let me remove the negative sign. So just say equals to, then interest. Then I just drag all through. Yeah, I have to be copy. So this will be the cash flow from financing. From financing activities. Financing activities. So I pick this. Then you just drag. Then let me bold it. Yeah, so now we have cash flow from financing activities, cash flow from investment, and cash flow from operations. So the net cash flow will be A plus B plus C. Yeah, so this was B. Sorry. Let me name this B. Then let me name this C. The net cash flow will be A plus B plus C. Yeah, so I'll have this plus this plus this. Yeah. So I'll have a negative cash flow there. So I'll just drag. Yeah. And this will be, you will add this to cash and equivalents, cash and cash equivalents at the beginning. That these are always financial assets. What you can convert into liquid, what can be converted into liquid form immediately, and what you can use. Yeah, and even on this question, there was no provision for bank, cash at bank or overdraft. There was no provision at all. There was no provision. Yeah, there was no provision for cash at bank. Yeah, so you are supposed to add it and it should balance to the cash and cash equivalent at the end. Yeah, so in this case, if it was cash flow, then we are going to compare the cash at bank in 2025 with the 2026, 27, 26, 28, 27, 29, 20, 29, 28, that way. So that we get the cash and cash equivalent. Again, I didn't there was nowhere where we had even the financial assets. Yeah, they were not there in this question. So I don't know. I don't know what the examiner. I don't know what the examiner thought. I don't. Yeah. So you can also make the comment. So this, yeah, as I say, cash and cash equivalent brought down. Let me just say it for learning purposes. So that when you add this plus this, it should balance with cash and cash equivalent at the end. Cash and cash equivalents carried down. Yeah, so it was supposed to give you those values. But unfortunately, I didn't have this, the cash and cash equivalents. Maybe, yeah, that's it. So that's how you're supposed to prepare the cash flow statement. So I'll go to the last part. Last part is part B. Undertake ratio analysis and complete the following financial ratios for the 5 years. So we have profitability ratios, which is return on assets. Yeah, so these are ratios. So the return on assets is the formula. Yeah, it's the total assets. The formula is always total assets divided by revenue. It's total assets divided by revenue. So return on assets always, the return on assets formula is always the net income over total assets. Yeah, it's the net income over total assets. Sorry for the mix up. So it's the net income. So the net income, you just come to the formula, you come to what is provided in the profit or loss. So the net income is the profit after tax, this one. Yeah. So that's the net income. So you take it and you divide by the total assets because that's the return on assets. So the total assets, it's here. So that's the formula. So you just say enter. So with that, you just drag. So it will copy for the rest, the remaining 4 years. So those are the values. Another thing will be return on equity. Return on equity. Yeah, it will also be net income over total equity. So I'll go to net income, which is here. You divide by the shareholders' equity, which is the total equity. So I just divide by this here. Yeah, so I'll drag it and the values will come automatically. Yeah, another thing was net profit margin. Net profit margin. Yeah, so the margin is on sales. Yeah, so the net profit margin will be the net income, which is the profit for the year. You divide by revenue. Yeah, so with that, you just drag, and the other name will be copied the other years. Yeah, so I'll go to just a minute. Let me scroll on through. Then we also have profitability. We have liquidity ratios, current ratio, and quick ratio. So just write here current ratio and quick ratio. You have to know the formula. So the current ratio is always current assets over current liabilities. Yeah, that's why it's called current ratio. So I just go to current assets. Yeah, current assets was account receivables only. So I'll divide by current liabilities, which is this. So I'll drag. It's 1. So it means that you can use your debt. You can use your equity to pay your debts comfortably. It's 1 all through. Then I'll go to quick ratio. Quick ratio is always cash and cash equivalent plus account receivables. You divide by current liabilities. Yeah. So other people say that it is the all the current assets minus inventory. Then you divide by current liability. So this is what I will do. Yeah, so I'll do the same. So I'll just go and check. Do you have cash and cash equivalent? I said it was not provided this question. Yeah, we didn't have cash at the back. So I'll just pick the account receivable. And I divide by current liability, yeah, which in this case is now the current liability is the account payable. So in this case, the quick ratio will be the same. So it will be the same with the current assets. Yeah, and up to that point, that's how you are supposed to do that question. And those who are yet to subscribe to my channel, please subscribe to my channel and like my video so that it can reach so many people who are sitting even for the April 2024 BDA paper. Thank you so much. And on the comment section, please comment on the missing information. Yeah, you can give your opinion on what is missing. And until next time, see you and bye-bye.